Welcome to StokTok's deep dive into Altria Group Inc. Altria is the largest cigarette manufacturer in the United States, with a dominant market position in combustible tobacco products, alongside a growing presence in smoke-free alternatives and oral nicotine products. At the time of recording, Altria trades at $67.86 per share. Over the past 52 weeks, the stock has traded between a low of $54.70 and a high of $70.51. The stock is currently trading above both its 50-day moving average of $66.03 and its 200-day moving average of $61.37, suggesting a structurally higher price level over the near and medium term. The Relative Strength Index, a momentum gauge, sits at 60.2, which is neutral territory. Let's work through the fundamentals scene by scene, starting with a quick business overview. Altria Group operates as a vertically integrated tobacco company with a fortress-like competitive position in the United States. Its economic moat rests on three pillars: decades of brand equity in iconic products, regulatory barriers to entry that protect incumbents, and pricing power derived from inelastic demand for addictive nicotine products. The company derives roughly 90% of cash flow from cigarette sales, a business that has been in secular decline, but remains highly profitable due to the company's ability to raise prices faster than volume falls. Altria also holds a minority stake in Anheuser-Busch InBev, a major global brewer, which diversifies its cash generation. The StokTok score for Altria is 58 out of 100, signaling a hold rating. Breaking that down across 5 dimensions, valuation scores 14 out of 20, suggesting the stock trades at a modest but not dramatic premium. Financial health scores 15 out of 20, indicating solid credit metrics with some leverage concerns. Profitability scores 20 out of 20, reflecting exceptional margin and return characteristics. Growth scores just 1 out of 20, reflecting negative to flat revenue expansion. Smart money scores 8 out of 20, suggesting limited institutional buying momentum. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Altria trades at a price-to-earnings multiple of 15.58 times trailing 12-month earnings. The forward price-to-earnings ratio, which uses Wall Street's consensus earnings estimate for the next fiscal year, stands at 11.42 times, which is considerably lower, and suggests that analysts expect meaningful earnings growth in the year ahead. The PEG ratio, which is the price-to-earnings multiple divided by expected earnings growth, sits at 0.69. A PEG below 1.0 is often interpreted by value investors as suggesting the stock offers reasonable value relative to growth expectations, though in Altria's case, that favorable reading reflects very low growth expectations rather than robust expansion. The enterprise value to EBITDA multiple, which compares the company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization, stands at 11.87 times. In our view, Altria's competitive moat and pricing power are structural strengths. The company faces regulatory pressure and secular volume declines in combustible tobacco, but its ability to consistently raise prices has historically allowed it to grow earnings even as unit volumes contract. This is not a growth story, but rather a harvest story, and the market appears to be pricing that reality correctly. GuruFocus Value, an intrinsic value model that uses multiple methodologies, estimates the fair value of Altria at $51.93 per share. At the time of recording, the stock trades at $64.17, which implies a margin of safety of negative 23.57%. In other words, based on this particular valuation framework, the stock trades at a premium to estimated intrinsic value. Wall Street analysts at the time of recording have a consensus mean price target of $66, with a high target of $74 and a low target of $50, based on input from 12 analysts covering the stock. That consensus target is roughly in line with current levels, which suggests the market is not dramatically overvalued or undervalued in the eyes of the institutional research community. The next earnings report is due April 30th, 2026, with the street expecting earnings per share of approximately $1.25, with estimates ranging from a low of $1.23 to a high of $1.27. Market sentiment around Altria, as of the creation of this video, leans bullish. Bank of America has recently raised its price target and earnings estimates, and the stock is receiving positive analyst attention as a reliable income vehicle for dividend-focused investors. Relative to large-cap consumer discretionary and consumer staple peers, Altria's valuation multiples are modest but not deeply discounted. The data suggests, in our view, that the stock is fairly valued to slightly premium priced. Not a screaming bargain, but not egregiously expensive either. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point financial health checklist developed to screen for balance sheet quality and operational soundness. Altria scores a 7 out of 9, which is solid. This score reflects healthy profitability, strong cash generation, and generally sound working capital management, though there are mild concerns around leverage and liquidity metrics, which we will discuss next. The Altman Z score is a bankruptcy risk model that combines 5 financial ratios to produce a single score. Altria scores 4.55, which places the company well into the safe zone. A Z-score above 3.0 indicates low bankruptcy risk, so Altria is firmly protected in this regard. Now let's examine the debt and liquidity picture more closely. The cash-to-debt ratio measures the amount of cash relative to total debt outstanding. Altria reports a cash-to-debt ratio of 0.17, which means the company has roughly 17 cents of cash for every dollar of debt. This is a low ratio, indicating that Altria is indeed leveraged. However, the company's interest coverage ratio, which divides operating earnings by interest expense, stands at 10.23 times. This means Altria generates over $10 of operating earnings for every dollar of interest it owes, providing ample cushion to service debt. The debt-to-equity ratio is negative 7.34. A negative debt-to-equity ratio occurs when a company has negative shareholders' equity, typically due to accumulated losses, share buybacks, or special dividends that exceed retained earnings. This is a notable structural feature of Altria's balance sheet and warrants scrutiny. The current ratio, which divides current assets by current liabilities, sits at 0.65. A current ratio below 1.0 suggests that current assets do not fully cover current liabilities and may point to liquidity risk. However, for a stable, mature cash-generative business like Altria, which operates in a non-cyclical industry and can turn inventory quickly, a current ratio below 1.0 is not necessarily alarming. In aggregate, the financial strength picture is one of a leveraged but operationally sound business. Altria carries meaningful debt but generates sufficient cash flow and earnings to service it reliably. The negative equity metric is a structural concern that reflects decades of shareholder-friendly capital allocation decisions, but it does not impair the company's operational solvency. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, stands at 28.29%. Return on invested capital measures how much profit the company generates for every dollar of capital it has invested in the business. A return on invested capital above 15% is generally considered excellent, and Altria's reading of 28.29% places it among the most capital-efficient large-cap businesses in the market. This is the hallmark of a company with a durable competitive moat and pricing power. Moving through the margin structure, gross profit margin is 72.21%. This means that after cost of goods sold, Altria retains over 72 cents of revenue. The operating margin, which deducts operating expenses from gross profit, is 59.76%. This extraordinarily high operating margin reflects the fixed cost nature of manufacturing and distribution, and the minimal marketing spend required for established, branded products in a captive market. Net profit margin, the bottom line after all expenses and taxes, is 34.5%. For context, the median large-cap company in the S&P 500 generates a net margin in the range of 8 to 12%. Altria's 34.5% net margin is in the rarefied air of the most profitable businesses globally. Free cash flow margin, which measures the cash the company generates after capital expenditures relative to revenue, stands at 45.06%. This is the cash available to dividends, debt service, and buybacks. The ability to convert nearly 45% of every revenue dollar into distributable cash is exceptional, and is a key reason why Altria can sustain its high dividend yield. In summary, Altria scores a perfect 20 out of 20 on the profitability dimension of the StokTok score. The business converts revenue into earnings and cash with outstanding efficiency. This is not a growth machine, but it is a magnificently profitable one. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at negative 0.9%. This means that on an annualized basis, Altria's revenues have contracted slightly. Over the past 5 years, revenue growth is positive 1.3%, indicating that the longer-term revenue trend is essentially flat with a marginal upward bias. This flat to negative revenue growth is the structural reality of the cigarette industry. Per capita cigarette consumption in the United States has been in secular decline for decades as smoking rates fall and regulatory pressures intensify. However, and this is crucial to understand, Altria has historically offset volume declines through price increases. The company raises prices faster than volumes fall, which allows it to grow earnings per share even as unit sales contract. This is the definition of a harvest business. Milk the cash flows while managing the long-term decline. Book value growth over the trailing 3 years is 2% per annum. Book value is the net asset value of the company, and 2% growth is below nominal GDP growth in the United States, which underscores the mature, non-expanding nature of the business. The dividend yield at the time of recording is 6.55%. This is an exceptionally high yield relative to the S&P 500 equity market, which has historically yielded in the range of 1.5 to 2%. For income-focused investors, this yield is a primary draw of owning Altria stock. The dividend is paid quarterly and has been reliably paid and grown for decades, though the sustainability of future growth in the dividend will depend on the company's ability to grow earnings despite structural headwinds in cigarette volumes. In sum, growth scores 1 out of 20 on the StokTok score. Altria is a zero growth or negative growth business in terms of revenue, and earnings growth is dependent on price increases and cost discipline rather than volume expansion or new market penetration. This is not the stock for an investor seeking capital appreciation. It is the stock for an investor seeking reliable, high current income. Now let's talk smart money. What institutional capital is actually doing with this name? Altria is held by 17 top-tier guru investors, as tracked by Dataroma, a database of SuperInvestor 13F filings. However, the recent direction of that holding is mixed. Thomas Russo, the portfolio manager of Gardner Russo & Quinn, a highly respected value investing firm, owns a small position but has been trimming it, reducing exposure by 0.56% in the most recent quarter. Lee Ainsley, who manages Maverick Capital, holds a minimal position and has reduced it by 61.85%, essentially exiting the holding. Yakman Asset Management, Dodge and Cox funds, and Mayors and Power funds all hold small positions with no recent trading activity. The broader institutional picture shows that 13.7% of 13F institutional filers, that is, professional money managers required to disclose holdings to the SEC, are net buyers of Altria, meaning they added more shares than they sold in the most recent period. A reading above 50% would indicate net bullish institutional sentiment. At 13.7%, the reading suggests institutional capital is net neutral to slightly skeptical on the name. Insider ownership is very low at 0.64%, indicating that management has minimal personal economic exposure to the stock's performance. Over the past 3 months, there have been 0 insider purchases and 1 insider sale, reinforcing the picture of low confidence from those closest to the business. The smart money dimension of the StokTok score for Altria is 8 out of 20, reflecting limited institutional buying momentum and cautious positioning from professional investors. This is not a name that excites the top-tier value managers or that is drawing fresh capital from institutional buyers at the current price. And finally, the verdict. Let's bring it all together. On valuation, Altria trades at a modest but not compelling discount to intrinsic value estimates. The forward PE ratio of 11.42 times and PEG ratio of 0.69 suggests the stock is not egregiously expensive, but the GuruFocus Value estimate implies a margin of safety of negative 23%, and Wall Street's consensus mean target is only 1% above current levels. Valuation, in our view, is fair but not a screaming bargain. On financial strength, Altria presents a mixed picture. The company has solid operational health with a Piotroski F-score of 7 and an Altman Z score of 4.55, indicating low bankruptcy risk. However, the company carries meaningful leverage, evidenced by a low cash-to-debt ratio and negative shareholders' equity. The strong interest coverage of 10.23 times provides comfort that debt service is not at risk, but investors should monitor the balance sheet structure. On profitability, Altria is exceptional. The company delivers a return on invested capital of 28.29%, a net margin of 34.5%, and a free cash flow margin of 45.06%. Few businesses in the world combine the pricing power and operational efficiency that Altria demonstrates. This is a cash generation machine. On growth, Altria delivers essentially nothing. Revenue is flat to negative, book value is growing at 2%, and earnings growth is contingent on price increases rather than volume or market expansion. This is a mature, declining business managed for cash extraction rather than expansion. On smart money, Altria is attracting minimal new institutional interest. 13.7% of 13F filers are buyers, well below bullish thresholds. Prominent value managers are trimming rather than accumulating. This may suggest that informed capital views the valuation as unattractive at current levels, or it may simply reflect the reality that growth-focused institutional mandates avoid zero-growth stocks. Overall, in our view, Altria is a dividend aristocrat in a secular decline, trading at fair value with exceptional profitability but no growth. The stock appears suited for income-focused investors with a long-time horizon and low expectations for capital appreciation. The principal risks to this thesis are further regulatory restrictions on tobacco sales, accelerated shifts to smoke-free products that the company fails to capture, or a macroeconomic downturn that forces dividend cuts to shore up balance sheet leverage. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Altria Group Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.